Hey there!
Hey now.
Facebook Live and what else we got? Instagram. We have YouTube.
Twitter? No.
Twitter. I don't know if I'm on Twitter, but
it's not called Twitter anymore.
Yeah, it's X. It's Brian Sinkoff here with Sinkoff Realty Group. We're at the Sinkoff Realty Group offices right here in Delmar.
Could you tell?
Joe Theismann.
Washington fan.
And you got a little Beastie Boys right there, MCA Day down in the city. So here we are. We're Brian Sinkoff alongside Drew Aiello. Drew, why don't you scoot over a little bit? Scoochie, scoochie, scoochie.
Good morning.
It's a good thing this is the rehearsal. This is just the rehearsal time.
Sure.
We're a little early. We're gonna wait. We got some questions as well. Drew, here, let's do this.
It's 11 o'clock. On the number.
Yeah. Stop. Yeah, we're waiting. Hold on. I gotta just answer an email. Give me a second. Stop.
I think we're going to talk about interest rates. I think we're going to talk about the housing market. I think we're going to talk about, is it a good time to buy?
Yes.
Is it a good time to sell?
So, yeah, here's the reality. We have a lot to discuss here on this this particular edition of the, what are we calling this? The Mortgage Minute? No, we're not calling it. No. Mortgage, you know.
It's a Sinkoff Realty Group.
Yeah, it's a Sinkoff Realty. It could be a sound off with Sinkoff mortgage style is what we're going to call it.
That's creative. You just make it up.
Yeah. Maybe you can click the pen a little louder for a distraction. Are people, can you hear us? Let's just check
sound off with Sinkoff
to see if we have audio. Just give me 1 second. We've got to test everything and make sure that we're good here to go. Let's see. All right, we're good. We got audio. Okay, so let's get this party started again. Brian Sinkoff Realty Group. We got Drew Aiello of Fairway Independent Mortgage.
Yes, sir.
We like to do these once a month. Now, full disclosure, we have not done a sound off with Sinkoff mortgage style, if you will, since July.
Yeah, when you told me that yesterday, I was kind of flabbergasted because that seems so long ago. It's really not that long ago, but it's long for us because we try to do one once a month.
We had vacations. We had new offices. We did. No excuses. Yeah. We dropped the ball.
Yeah.
So we're going to get back to this. We're going to do this once a month, every month. And you just have to stay tuned for it as to when it comes out. But we're going to answer your questions. If you have questions, you can post them right here in this thread. We're also going to talk about the real world of real estate and mortgages. Now, the elephant in the room is that the rates are high.
Right.
And it's, a terrible time to sell. It's a terrible time to buy. So Drew, just for informational purposes only, right? We could say the rates are hovering around, what, 8%?
I bet you could say that they are hovering around 8%. Locked somebody in this morning on the way here, actually, a little below 8%, but that was a special program. So, yeah, you could say that. The highest levels that we've seen the 10-year Treasury since 2007. We actually touched 5% on the 10-year Treasury yesterday, which, again, we haven't seen since 2007.
What's normal, by the way?
Normal is, well, over the last 40 years, believe it or not, the average 30-year fixed-rate mortgage is 8.25 over the last 40 years. So, normal since 2008, 2009, this is not normal. Normal over the last 40 years, this is normal.
Right.
That being said, I know I've said this now for the last 6 months, but I firmly believe it'll happen if we record this, count this day in history, look a year from now, you're probably looking at much lower interest rates, somewhere in the 5s.
Mm-hmm.
So it's stickier than I thought. I thought we'd be in the 5s by the end of this year, but there's a lot of things happening, a lot of geopolitical events that are happening that have caused some turmoil, and some of the economic data is still coming in that's hotter than we expected. I think part of the big reason is actually the Fed is looking in the rearview mirror instead of looking at current data on what's happening today. They have this goal to get rates down to 2% in terms of the inflation rate. I believe that they're close to it already. They're probably around 2.5%, but they keep looking at data from last month and the month before instead of present day. So once that catches up, and the Fed realizes, oh shoot, we went too far, inflation is in check, then I think you're going to see rates come down in a dramatic way.
Right.
So, which leads to our other conversation. Is now a good time to buy? I would most definitely, unequivocally say yes, just because there's limited supply, which you can attest to, and right now rates are around 8%. So the buyers are out there, the supply is limited, and if rates go down, say into the fives, there'll probably be more buyers and less supply.
Right. And you bring up, Drew and I know a lot of times people, you read something, you hear something, whether it's on the news or your friend at the office, and
Google.
You Google.
Google.
So, you hear some. Drew and I, we like to say we're in the real estate salt mines. We're getting our hands dirty. We're in the fields. We're working it. We see this stuff every day. So you read an article on what the Fed's done or what the rates are done. That's great, but we like to deal in real world. And remember, what you see on the internet and what you read is a national generic scale. It's not necessarily dealing with the capital region, the housing market here in Albany, and
that's a great point.
You know what I mean? So I think you gotta take that with a grain of salt. Like, oh, the sky is falling. Well, is the sky falling in San Francisco, Florida, and Vegas? It's not necessarily falling here. And I think that's something you always have to keep in perspective. And I think you need to keep that in perspective, not just about real estate, but in any sort of national trends, whatever that may be. It's got to sort of, you need to laser focus that to our community, okay? And we are in the community doing this on a daily basis. So,
and there's a show I watch all day long in my office. I have it on mute. It's always on. It's 4-letter abbreviation, financial services type show. I'm not going to mention the name. There is a real estate lady on that show that even found holes in real estate during 2020, 2021, and 2022.
Mm-hmm.
You could fathom that. The housing market was on a tear. And she always found the negative. So if you listen to a lot of the media, and if it bleeds, it reads. Unfortunately, that's the way the media is. So they like to make everything.
Well, and again, it's not even that. It's just national trends don't necessarily have to do with Albany. I think that's important on anything. So maybe you could hit your phone on silent there, Sparky.
It's the iPad.
Well, maybe you can turn that off, and that's feel free. We're doing a show. We're on live.
I don't know how to.
Yeah, just turn it off, dude. This Fisher Price. This just into the newsroom. All right. Let's talk a little bit about.
Tough crowd.
It is a rough crowd. I love
thick skin to be in this office.
Yeah. All right. So let's talk a little bit about. We talked about being in the salt mines and doing this every day. I've noticed a couple of trends. What I've noticed in this market is this: you have a lot of buyers, and I have these conversations with buyers all the time. Okay, you have a lot of buyers, and I think one thing to keep in mind that Drew and I, we can give each individual buyer their situation. We can give them the scenario of the market, whether it's they want to buy or sell. But ultimately, we're just the tour guides. The buyers and or the sellers have to make the decision, do they want to buy a specific house? I'm never going to tell them to buy a house. I'll tell them not to buy a house because of things I've seen. And same thing with Drew. He's going to say, hey, here's what you're qualified for. But ultimately, it's a buyer or seller's decision as to if they want to move forward. We just give them the data, the information of what we're seeing and what we're experiencing. And what I'm experiencing is you have a lot of buyers that are talking to their neighbor in the cubicle at work who got the 3.5% rate.
Correct.
And they want to buy a home because their rent's $1,800 a month for a 2-bedroom. And they really are interested in buying, but they look at their neighbors or their friend or their colleague or their work cubicle buddy or gal or whatever, and they go, I'm not buying a house. The rate's 7.5% or 8%. You got yours for 3%. All right, let's time out. There will never be 3% interest rates again, people. There'll never be 4%. I don't want to say never, but highly unlikely.
If you're lucky, 4.5%.
Right. So stop thinking you're going to get your work buddy's rate from 3 years ago in the heart of COVID, when the rates had to go down to stimulate spending and stimulate one sector of the economy that worked. So that's never going to happen.
Keep
okay,
in mind, for that to happen,
there has to be another
it
apocalypse.
has to be a major economic hit. We're talking 2008, 2009. We're talking COVID. That's what happens when you see rates go down, or rates go down because of
Poop
things
hits
like
the
that.
fan.
So we don't want any catastrophes to happen that would cause rates to go to 3% again.
Right.
That's the only time that's
So-
going to happen.
So that's not going to happen again. So you have these buyers sort of on the fence saying, well, the rate's so high. But the flip side, and this is real world example, people, the flip side is that houses, well-priced homes in any market are going to sell. Okay, and they're usually going to sell in a timely manner for top dollar. May not be over asking. But I have seen a lot less houses go for that exorbitant number over the asking price.
That's good.
I want to say in the last 2 months. And guys,
good.
gals, that's awesome. That's normal. We talked about normalizing the market, Drew.
That's what this is not normal. What we've had the last 24 to 36 months is not normal. And it was needed. There was a lot of pent-up demand, and now the market is working towards normalization. That being said, there's a massive generation still going through the pipeline, the largest of all time, the millennial generation, from age, say, 24 to like 44, somewhere in that range, are the millennials. To be, I'm not, don't quote me on the specifics, but that's a huge generation. That generation does not peak out for another 2 to 3 years. That's peak out. Still going to be a massive amount of people going through the pipeline, and we know what happens between 24 and 44. We find a mate. We may get married. We want to settle down. We want to put down roots. We want to buy a house. All those
Have
big
kids.
life-changing things are going to happen for the next several years. So, firstly, I like to poo-poo like a lot of the TV stuff that we're in a housing bubble. By no means are we in a housing bubble right now. We still have big demand. There's basic principles, the basic principles of supply and demand. There's more demand than there is supply. So I think you'll continue to see appreciation in real estate. I thought this year we would get maybe 4 or 5%, probably going to be closer to 8 or 9% when it's all said and done by the end of the year. So appreciation is still there. I truly believe that if you buy a house today, 6 months from now, that same house will cost you more. So, and that's one thing that we'll probably talk about, the cost of waiting. I don't think is in your favor in this real estate environment right now, regardless of the interest rates.
Yep, and that's gonna be our next topic. It's gonna be called the cost of waiting. And I will just, before you get into that, I'm gonna throw out something. We talked about, the buyer who's waiting for the rates to go to 4% and they're not buying until that happens. Well, you're gonna be waiting for Godot, because that ain't gonna happen. I mean, good luck with that. One thing I've seen, and we actually talked, unrelated even to this Facebook Live, we have talked in the last couple of weeks, and I said, Drew, I'm seeing more houses sit on the market, and they've had to reduce the price because they haven't sold. Right. That has not happened in 3.5 years, because no matter what you put the house on the market for, it's sold, and it's sold over asking price. The danger now is you have people, and I'm not going to dog any realtors or even any sellers, but sellers are saying, well, I can list my house for whatever, and it's going to get multiple offers and sell over asking. My contention, and I've always been, and maybe one of the reasons why my house, statistically, I think my house has sit on the market for 2.1 days or something crazy when I list a home, is because I price the house where I think it's going to sell, and I let the market dictate the crazy. Right. Okay, so let's price it here, not down here where it should be based on everything, and then let the market take it up here. I think what we're having, and I don't think we as agents, as sellers, just as the society, we have not maybe caught up to, okay, don't price it here because it's not going to end up here. Right. It's still price it here, and instead of ending up here, maybe it ends up there, right? So you have a little bit, what's happening here is you have a little bit of overpricing But again, there's less buyers out there. The rates are higher. So is someone going to pay $50,000 over asking price when their rate's 8%? Right. Personally, if I'm a buyer, and then we'll get into your the cost of waiting. But personally, if I'm a buyer, I'd rather pay that higher mortgage rate now than overpay for the house and be stuck to that house, that number, that mortgage amount for 30 years. You may be stuck to this rate for 1 year when you can refinance.
That's the old thing. We've said it a million times.
Say it. You date the rate, you marry that house, baby.
The rate is temporary.
Put a ring on it. Put a ring on it. You got to put a ring on it.
We've hit a new
put a ring on it, right? Oh, 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 oh. Okay. All right. So put a yeah. We long time ago, buddy. So we put a ring on that thing. Let's get back into being.
A couple good things.
We have to make you laugh.
Right.
You're entertained.
Right. You can't keep it too straight and boring. A couple good things that you brought up that are good for potential buyers in this market and good for potential sellers in this market. Mm-hmm. Cost of waiting to any potential buyer is still not in their favor, regardless of interest rates. And I have
he's got flow charts.
I have calculators that can show people the cost of waiting. And we can look at if they waited 6 months, if they waited a year, if they waited 2 years, 3 years.
Let's just
realistic time frames.
Yeah, give us some numbers. Just we're not going to show the kids. Just you read it aloud.
Right. Like for example, you find a house today. This house was actually done on a house on New Scotland Ave in Albany. It's $350,000, and if you waited a year, guess what? That house now is $370,000. Or if you waited 2 years, that house will be $385,000 based on current appreciation. So, or actually, it's more based on historical appreciation, which is better than current appreciation, because right now we're obviously pretty accelerated. So, yes, the rate may go down from, say, mid to upper sevens, might go down to 6.5, what have you. But the cost of waiting is still not in your favor, where you would have lost over the next 1 year, 2 year, 3 year period of time, anywhere from $22,000 to $30,000 to $40,000 to $50,000 in terms of appreciation and paying down your mortgage. So those two factors hurt you, because if you buy a house today, you're obviously paying part of the principal down every month, plus you're going to have appreciation over the next 6, 12, 36 months. And it's all right here in the calculator. So any house that you are interested in, I could show you unequivocally the cost of waiting. So not a good move in this environment because, like I said, we still have more demand than supply. Appreciation real estate will continue, especially in the capital region. And forget the national numbers. For those of you, and you touched on this, that are afraid maybe to go a little bit higher than ask, which obviously it's not comfortable for a lot of people. You have to trust your realtor, trust your agent that he or she is doing the best thing for you. But if you did go over ask, I do have a calculator also that tells you if you did go over the asking price by $5,000, $10,000, $20,000, whatever that number is, how soon can you get your money back? And the same house, break-even point on this house is 8 months if they went over the asking price by $5,000. And
so
over
if
the next
it was
5 years,
so if it was a 350 house, 5% would be
$5,000. So you're paying. Actually, the asking price for this house was $345,000. They went to $350,000, so they went $5,000 over. It would take them 8 months to break even on the house. But over the next 5 years, based on 63 years of historical appreciation, not just the last few years, 63 years of appreciation, they would have almost $75,000 in equity in that house, or appreciation in that house. So once again, sometimes it is necessary to go higher. Really love the house. You think you're going to be in the house for a long time. Obviously, you're trusting your agent so that you're not going to an exorbitant level. It makes sense. And then here's another thing that I want to talk about for the and this is something you can't see on film, but for the houses, like you said, you're starting to see a little bit prices maybe being reduced, houses staying on the market longer. This is all good for real estate. It's all good for buyers. It's all good for sellers. The market is trying to find its footing to a normal level. Instead of reducing purchase prices on houses, sellers can offer buyers a 2-1 buy down, which means, let's use your example. Say rates are 7.5%. Guess what? Year 1, your rate would be 5.5%. Year 2, your rate would be 6.5%. And then if you still have the mortgage over the next 28 years, you'd be at that 7.5%. But I firmly believe over the next year or two, you're going to refinance and not have this mortgage, as we've discussed. But it helps the seller because they don't have to reduce their purchase price by $10,000 or $15,000, and it helps the buyer because instead of at a 7.5% rate, they have a 5.5% rate or a 6.5% rate. So it's hugely beneficial to both sides when you have somewhat of a normalized market.
And how does that work in terms of the transaction? What does that cost? Who pays for it? All that type of stuff.
So a 2-1 buy down has to be paid for by the seller.
Okay.
And for example, we'll just stick with our $350,000 house. It would cost, well, the seller pays the cost between 7.5 and 5.5, and 7.5 and 6.5. That interest expense, they set that money aside in a separate escrow account, and that makes the bank whole every month on the amount of the lower payment that the buyer is paying. So in reality, though, it's only costing the seller about 2.25% of the purchase price of the house. So instead of doing what you normally see, a 3% seller concession, things like that, or if you drop your purchase price by $10,000, which is normal, it costs the seller much less than that, only maybe $7,900 in this example. That gets paid for by the seller. That money sits in an escrow account. The buyer's super happy because in year 1, they're going to be saving $436 a month on their payment. A month.
And I think it's also imperative to know when you say the seller pays for it. Remember, the seller, assuming they don't owe anything or they have equity in the home, it's not like the seller is stroking a check to the bank at the closing. It's just taken out as part of an expense on a sale.
Seller concession.
Yeah. So instead of the seller concession, maybe giving it back to the buyers, you're essentially putting that in escrow to fundamentally buy down that rate in English, in layman's terms.
Exactly. And what's also great about this, so let's say 18 months go by and you're on this 2-1 buy down program, you refinance. Guess what? That money that's sitting in that separate side account for that buy down of the rate when you bought the house, that comes back to you.
To who?
The buyer, the homeowner, and you can use it to pay down the principal or whatever's outstanding.
But you can if you do that, you can refinance
anytime. Yeah,
okay.
No prepayment penalties at all. You can refinance anytime.
So
it's just a really great program in this environment.
So I think what sort of the lesson learned here is, in a tough real estate market where the rates are high and there's a lot of chatter, places like Drew, Fairway, Independent Mortgage, they're finding ways to make a buyer maybe stomach it a little easier, maybe get through it a little easier, both mentally and physically, in terms of physically what you're spending a month. And, from a real estate perspective, I think it's imperative to know that, I can tell you in the last 3 months, I have not seen 12 offers. I'll never forget, and I tell this story almost every time. I will never forget. She might even be watching on Facebook Live. I listed a house in East Greenbush, Averill Park. It was listed for $275. Okay, this was. We can look it up. We can literally look it up. That I'm not BSing you.
Before you
it was
open the
Clement.
house.
Yeah, it was Clement Drive in Averill Park, East Greenbush. Okay, I had an open house. It was like March of 21. Okay, this was terrible. I had an open house at noon. I show up at 11:40. Okay, there were 7 couples waiting. I had them electronically sign in the driveway. I had 52 couples in the open house. It was like Black Friday at Best Buy, okay, when they were selling, $100 TVs. It was ridiculous. I had 17 offers, okay. The house sold for $70,000 over the asking price.
What year was that again?
2021.
2021. Yeah.
It was March of 21. I said to Drew, my seller was ecstatic, left me a great review, referred me to people, obviously. I mean, I told her, I said, this was a little eBay uncracked. Let's not, this is not, I'm good, I ain't that good.
Right.
You know what I'm saying? You know what I'm saying? I wasn't that good. It was the pent up demand. It was the market. People were starting to get out a little bit at that time.
Right. We had gotten through another winter.
Yeah.
COVID surge. And all that. March, right.
So
cabin fever.
Yep. So it was, again, something that, I'll never, and at the time I said to people, including you, I said, Drew, I don't think this is good. Remember, we had those conversations. I was like, this is not normal. It's got to normalize. And then, I sold a month later a house on Washington Park, a 3-family. At the time, it set the record for the highest 3-family on Washington Park. I had realtors who were listing multifamilies on Washington Park then call me and thanked me for setting the bar high.
That helps with the future appraisal.
Yeah, because I think we went like $150,000 over the previous 3-family, 3-unit property on the park. So those weren't normal times. Okay, so my point is what I'm saying is I have not seen in the last several properties I've listed, instead of 6, and now I'll say that was abnormal. What was normal in this market, I would say, would be, and this doing mortgages, would be between 4 and 10 offers. Mm-hmm. Like that was pretty normal. Now we're seeing 1 to 3 offers. Right. Still multiples, sometimes not multiples, but way more normal, way more stomachable for a buyer. Right. And you're not seeing, at least I'm not seeing, sometimes you are, depending where the house is, whatever, exceptions to every rule, as I like to say. Right. But we're generally not seeing the craziness. We talked, Drew, almost a year ago, last December. Remember when we said, if you need seller's concessions and you need an FHA loan, you got 2 months to do it.
And we did 2 deals.
We did 2 deals.
FHA with
in those 2 months.
Which we hadn't done in 2 years.
2.5 years. We are telling you, between now and I think through the rest of this winter at least, if you have a deal with seller's concessions or if you have an FHA loan, and again, nothing wrong with an FHA loan, but in a competitive market, sellers want that conventional, they want that cash deal. Right. Now is the time, to maybe try to buy using an FHA or even getting concessions.
Here's what will happen. Right now we are elevated 7.5%, 8%, whatever you want to call it. We know the writing's on the wall. Things are going to improve in terms of interest rates. And I think when that does happen, it's not like there's going to be a light switch that goes off. But all of a sudden, the bell's not going to ring and it's going to say time to buy. Rates are going to come down, and I think they're going to come down pretty dramatically. I don't think it's going to be a slow thing. I think you're going to see a dramatic decrease because, once again, they're going to realize you went too far with bumping rates. Inflation's under control. The economy's not rolling along as great as we had thought. So I think that's going to happen. We had a big hedge fund guy yesterday. This guy Bill Ackman. He was on CNBC, and he had this thing called a short position, which is maybe for another Facebook Live thing. But basically,
on your own time.
He's a multi-billionaire, runs a huge activist investor hedge fund type thing, and he got out of his long bond position. Like, he feels that rates are going to start to go down, and that there's the biggest short position we've ever seen in the history of the 10-year Treasury right now. And then when people come back into the market and cover the shorts, which again for another time, once again that'll move momentum down, and you'll start to see interest rates come down. But I think now's the time, because you don't want to wait for that to happen. You want to be ahead of that.
Well, and the reality also, Drew, is what's going to happen. Right, it's not going to be the floodgates. You're going to get inundated with 87 phone calls in a day. But I would say when those rates do come down, 2 weeks is going to be an influx of buyers. Right. Is there going to be that same influx of sellers? That's the issue.
It's always going to be the issue for the
right.
next few years at least.
Yeah, but look, I do think, and we're spitballing, we're back in the napkin chatting here on Facebook Live, so there's nothing like official. It's just our sort of opinions at this point.
We have disclaimers.
Yeah, this is opinion only. It's my personal
Not by
opinion.
the company.
No policies here.
Individual opinions only.
Yeah, right. My opinion is that there are some sellers out there that are, they're stuck in a twofold. They're like, the rates are so high. I probably, pretend just assume they refinanced. They're probably 5% or less. I think that's a fair assumption, right?
That makes sense.
A seller's not gonna, they know they're gonna get pretty good dollar for their house right now, but are they gonna be all warm and fuzzy about 7.5%, 8% on an interest rate for a new purchase? Probably not. So yes, people say, Sinkoff, why aren't sellers selling? I'm like, well, you're a seller. What's your rate? Oh, it's 4.5, or I refinanced when it was dumb. It was 2.9. I'm like, okay, the rates are almost 8. You have a lot of equity in your home. Are you buying? They're like, no. I said, but are you gonna buy and sell when it's 5? They're like, yeah, probably. So there is some of that too.
I think they can swallow that a lot easier than I'm getting out of my 3 to go into 8.
Right.
That's a hard pill to swallow. But if I get out of my 3 and go to a 5.
5.5, that's normal.
I can deal with that because I have a ton of equity in my house right now. I'm going to put that down on the new house, and my payment, even though my rate's going up, will probably go down.
Yep.
So.
Drew, why don't you, again, Brian Sinkoff, broker owner of the Sinkoff Realty Group. We're in my office, 316 Delaware Avenue, Suite 24, right here in Del Mar, the heart of Del Mar, if you will. And if you have traveled through these parts, you have hopefully seen the sign in Main Square. And Drew Aiello. Drew, give us your stats. Fairway Independent Mortgage. Where are you? How do we reach you?
My office is in Clifton Park, New York. I'm the branch manager at 7 Southside Drive in Clifton Park.
And that's next to the
the heart of Clifton Park.
It is
right
easy to find.
Five Guys, Jersey Mike's, Hot Yoga. We got it. Druthers. Yeah, I'm right there. Right there. Easy, right off exit 9. But been a branch manager now for a year and a half with Fairway Independent Mortgage. Been in the mortgage industry now. January will be 29 years. January of 1995, folks.
Wow, you're looking good for
your
age.
I thought I'd try it out for a few years, and here we are 29 years later. But been in business a long time. We have every program under the sun, including, believe it or not, reverse mortgages, which are making a big comeback for the 62 and over community. But a lot of tools, a lot of calculators. I am purely based on education. I will not tell you ever what to do.
Mm-hmm.
I will purely give you the education to make an educated decision so that you can decide which program is best for you. And that's how I've always done it.
And I think that's one thing, and those that are watching and those that have used either of us or maybe both of us in real estate transactions will tell you we're never going to push you to do anything you're not comfortable with, because the worst feeling I have as a broker owner, as a realtor, as a real estate owner of a real estate firm is telling a client to do something that they weren't comfortable doing.
No,
and
I never want someone to lose sleep over the mortgage payment.
Yeah, and I don't want to lose sleep over the decision. That's something that I told them. Sure. So you have to be a straight shooter.
We're for life. We have kids. You have kids. We got wives. We're going to be in this for a long time. And our business is built solely on referrals and happy customers. Yep.
And I think I just kind of want to end with this, and I think this is really imperative, and I'm not going to get corny or sappy, but I am. I have always told my clients long after the transaction ends to use me as a resource, okay? I don't care what it's about, something to do with the home, or even just honestly, sometimes people call me for life questions, because we kind of get life. We're kind of tied into a lot of different industries, right?
Business.
Exactly.
People buy a house maybe 2-3 times their whole life. We're doing that, every week.
Yep. And not only the real estate stuff, but the ancillary stuff, the fencing companies and gutters and lawn and snow removal, and just questions about maybe neighbor issues. So I always tell every one of my clients after the transaction ends, I don't want to be a stranger. I'm going to keep in touch with you. Don't lose sight of the fact that you can always call me, even though, quote unquote, our transaction has ended. Correct. So I get a call, I'm not going to name this person's name, but a good buddy of mine has an issue with his neighbor, just an insurance thing. I'm not even going to get into it, but just what should he do? Something happened, high wind, did something.
Oh, the tree.
Yeah, whatever, that type of thing. We're going to keep it generic.
Okay.
But he was getting various opinions from people in his family and various opinions from his parents and her parents. And he called me and he said something so sort of profound to me and so meaningful. And he said, Brian, I know you're an honest guy. You're a straight shooter. You're sort of independent in this situation. But my family, my wife, my entire family trusts your opinion and trusts what you said. So I don't want to make it seem like I was the judge and had the final say in this matter. But he called me and said, I'm going to listen to what Brian says to do in this case.
Opinion, so you can make a decision.
Correct. Right. And he says, Brian, I want to hear what you have to say because I respect your opinion. And it made me feel really touched. And I'm not being corny or sappy, but it made me feel touched because here's a guy I did a transaction with. He's referred me obviously to a lot of members of his family, but he looked at me beyond just the realtor. Yep. And that's what I love. And I think that's where the value of using me, and I know using Drew, you have the same type of morals and standards and ethics. That's the beauty of the way we do business.
A lot of people call us trusted advisors, and that's not a mortgage loan officer, not a real estate agent, but trusted advisors, because this is what we do. We live it, we breathe it, we sleep it, and hopefully we have a lot of knowledge that we can share. So,
yeah,
it's a good day.
Awesome. Well,
sunny day in Del Mar, New York.
Yeah.
The leaves are absolutely beautiful.
I don't want to depress you, but we are going to lose about an hour and 20 minutes of light over the next 5 weeks. So.
Well, I know November 4th, right, is daylight saving.
Yeah,
November 5th, technically, is Sunday.
Yeah. So it's honestly the most depressing month of the year, November. But we don't want to. I don't want to leave you on a bad note.
Don't forget, November has my favorite holiday in it.
Thanksgiving.
So, the best.
Yeah, it is.
Football and eating.
Turkey.
And no presents.
Yeah.
Even though I like giving out presents that following
Good one.
month, but this November holiday is eating. And did I mention leftovers?
Oh, there's nothing better than a leftover turkey sandwich.
The next day.
Yes.
Exactly.
Yes. So we want to thank you so much for watching again. We're going to be back here next month doing this again.
We're not going to go 2 months.
No, we're going to be more consistent. We try to do the beginning of each month. But we thank you so much for watching again. Brian Sinkoff, broker owner, Sinkoff Realty Group. It's SinkoffRealtyGroup.com, 518-364-9497. The email Brian@Sinkoff Realty Group. Just Google me or message me. You know how to freaking get a hold of me at this point. Drew, give me your info.
Drew Aiello of Fairway Independent Mortgage. Just go to drewsteam.com. drewsteam.com. Easiest way to jump online, punch your information, give me a call or text. It's just the easiest way.
And I'm going to put us both on the spot here. I'm going to surprise Drew. For the next 2 months. Are you ready? For our next 2 Facebook Lives. Because Drew mentioned it's Thanksgiving, and then the following month is, Hanukkah, Christmas, Kwanzaa, and just December. We're going to be having, you ready? We're going to be giving something away on these Facebook Lives.
Okay.
Right? Okay. We're going to be giving stuff away on these Facebook Lives. And it's going to be good. No, it's going to be one gift per live.
That's awesome.
So you need to stay tuned for that.
So this is October.
So it'll be November,
December,
and December, and it might. You know what? If we get good response, it might continue.
All right.
And we'll suffer the consequences.
I'd rather give a gift than receive a gift. So
that's me too.
I'm totally fine.
I'm good like that.
Yep.
All right.
Give.
Hey, be well, everybody. Stay safe. Much love, and thank you so much for watching.
Have a great day.
Drew, let's give the goodbye.
Are you teaching me this on the fly? What else am I supposed to do?
There you go.